Have we already started seeing the restraint on the economy now more than 2 years since the Fed started decelerating policy?
Well, a very significant monetary deceleration is underway, and we know this not by just looking at the yield curve or the money supply, but all of the various key financial indicators that the Fed has an important influence of. The bank balance sheet, both the asset side and the liability side, the growth rate is collapsing. In addition, the velocity of money is continuing a multi-year decline, and the yield curve is flattening very significantly. If one goes back to 1921, there have been 17 significant flattenings in the yield curve, and they all preceded recessions. The timing varied, there's a lot of variables at work, but the whole monetary constellation is becoming increasingly restrictive.
You talked about the balance sheet, and the monetary base has already seen a big decline already on the Fed's actions, and you use excess reserves rather than the Fed funds rate to measure tightening. So how restrictive is reducing the balance sheet as compared to Fed rate hikes?
Well, that's a very significant question. If one looks at each of the 6 hikes in the federal funds rate and sort of smooths out the actions, because excess reserves, the monetary base, are very, very volatile indicators. A lot of things are going on. Each hike in the federal funds rate required about a $70 billion reduction in excess reserves, or a total of a little bit more than $400 billion for the 6 hikes. But in addition, the Fed scheduled $30 billion of balance sheet reduction in the fourth quarter, $60 billion in the first quarter, and $90 billion in this quarter. And if the Fed achieves that target by mid-year, in terms of excess reserves, there will not be 6 hikes in the federal funds rate. There will be the equivalent of 9 hikes. So monetary policy is increasingly restrictive.